Hi, everybody. Welcome back to another Sensible Sundays where we are empowering home sellers, home buyers, and investors to be well-informed consumers from the start of their real estate journey. And today's topic is all about this 3% down conventional loan that will actually help you with the down payment money. So if you are a home buyer and you're interested in purchasing and you would like some help with that down payment, you want to watch this video. Today I have on with me a special guest by the name of Mr. Josh Ebo with Vibrant Mortgage. He's one of my preferred lenders. Finally, right? I finally inducted you.
Finally, thank you, thank you. I was waiting for that.
Yeah, so he's gonna tell us all about this product. He's very excited about it. He sent me a couple of emails about it. So I said, okay, we definitely have to share this with my audience. And so that's what we're gonna be talking about today. I don't know if you guys seen Josh on before. What was the name of that video that we did when you were like beefed up on NyQuil?
Man, that's the struggle. I wanted to make some time and really explain what we were talking about. And I had a cold. You guys didn't know that. I was holding it down really well. And right before that shot, I had gotten a gulp of a NyQuil in.
And so throughout the whole interview, Josh was like falling over.
10 minutes into it, I'm like, oh geez, I don't know if I can make it. I'm about to fail this DUI.
So you guys, if you haven't seen that video, you got to check it out. What is the name of that video? I think it's why home buyers should never trust non-MLS sites. They should only trust realtor sites. So I talk about that in that video. So guys, make sure you go back and take a look at what we're talking about. And if you see how Josh looks,
Des did a great job making me look good. She did a good job making me look good. But if you guys saw the unedited version, you'd be like, what is wrong with you?
Yeah. It was
I wasn't okay.
Anyway, give us a shout out on this link if you do go back and watch that. So we're going to get into that 3% conventional loan that helps you with your down payment, which I can't believe it. So you have to definitely share the product, tell us what the requirements are, what's the process, what's the turnaround time and closing out on the loan. Give us the goods.
I mean, it's a fantastic product. It's been out for a while now. Basically, what it is, it's a conventional loan. So what that means is, when you're looking for a home and you're looking for financing, the best loan type that you can get is a conventional loan. Basically, it's bread and butter, it's vanilla. The banks like the numbers, it's conventional, they see it all the time. They see it as no risk or less risky, and they'll give you the better interest rate and better terms on the conventional loan.
And you know what? Can I step in for a second?
Sure.
I have clients that sometimes they have FHA and they ask me that very same reason, especially being in multiple office situations. And I'm like, oh my gosh, let me see, like, how can I get them into a conventional? Because if sellers see that it's FHA and then it's multiple office situation, 100 times out of 100 times, 10 times out of 10, they're going to go with a conventional, a buyer that has a conventional loan
and that's true. Absolutely.
But why is it so what is it about FHA that, what makes it risky?
Well, it's not risky. FHA is a great product, financial product, but it's geared towards first-time homeowners that don't have enough of a down payment to put on the property, and the bank sees that as more risky because it's less skin in the game by the person that's borrowing the money. Of course, not everybody's going to have 20% or the amount that's necessary to get into a traditional conventional loan. So I believe it was in the 30s the FHA program was born, and the premise is, the United States government basically guarantees they guarantee that basically this borrower, will not default on the loan. And with the FHA program, basically there's a lot of other variables that go into the mix. First and foremost, there are, of course, rules that have to be met on the lender side, and if on the government side, and then there's overlays on the lender side if they choose to put extra conditions on it in order to get that loan. And you're getting the government involved. They're going to get involved, so that requires a little bit more of a process on the loan officer side. We have to get signed up with the government body, and of course, just kind of run it through them to see if it qualifies. So there's essentially, it all boils down to it's easier to go through with a conventional loan. If you have a choice between a conventional loan and an FHA loan, it usually is best to go with the conventional product. Even though the FHA product on the rate side is attractive and usually comparable as far as rate is concerned, there's an additional factor of mortgage insurance that's applied to FHA loan, which makes the loan a little bit more on a monthly basis expensive,
right?
Or costlier than a conventional loan. That makes sense.
And with conventional loan, they don't have mortgage. What is it, like a mortgage premium, right? Or
right. So with the traditional conventional loan, there's no PMI attached because you've put 20% down with the traditional. Okay. So if you own more than 20% of the equity of the home when you buy it or when you refinance, you're automatically put in a conventional loan. If you own less than 20%, that's when you typically you have to deal with like the FHA products and other products such as that.
Oh, okay. So would you say that what's the standard qualification for a conventional loan? Is it 5% or do you have to do 20%?
So with the traditional conventional loan, it was 20%. You're coming to the table. You're paying, if the house is $100,000, you're bringing the large sum of 20%.
Yeah.
And the bank will finance 80% of your loan, which is $80,000. And again, they see that as very traditional, very bread and butter deal, and especially if they're dealing with a higher credit FICO client. They'll do that all day, and the client has had a job for a certain period of time, 2 years, and they will continue having a job. So they will finance that type of client. If you skew out of those ratios, out of those parameters, that's when it starts getting dicey, and you might have to look at another finance product.
Okay, so that just means that this product that you have, that's 3%, and it actually will allow seller concessions to help pay for your down payment. This is a really good product.
It's a good product, but let me add to it. It doesn't avoid MI completely.
Okay, which is mortgage insurance, right?
Yeah, which is mortgage insurance.
Okay.
It does make it cheaper. You're not paying as much, depending on how much you want to finance. So, conventional loan and an FHA product, if you put those two, side to side, the conventional will win. Because the mortgage insurance is, payment is less and they charge you less of a percentage on your mortgage insurance.
So let's start off with the requirements for that product. Like, what is the requirements for that?
If I believe, the credit score you need and that's necessary for the 3% product is a 680 score, right?
680?
680 score. You need that at least. Basically, your DTI, debt to income ratio, what that means is your gross income, divided by all of your debts on a monthly basis have to be below a certain point. The lower, the better. 50% is where I would say is the cap. Okay. We do have to run it through Fannie Mae or Freddie Mac, DULP, to see if it gets approved. And basically it's always a toss-up, but the better the ratio looks, the better, the more likely they will approve it.
Okay.
And the advantage to this product compared to the FHA, again, the MI is less, but it requires you to bring less to the table. FHA is usually a minimum of 3.5, 3.5, right?
Mm-hmm.
With this conventional loan product it's 3%. In essence, if you technically look at it, if when I'm talking to my customers, I'm telling them, hey, listen, if you have parents or friends or family members that are willing to borrow you that 3%,
mm-hmm.
you can essentially get into this program with not a lot of money, right? Everybody and anybody can do it if you have the right loan amount where it's not like overburdenous.
Mm-hmm.
You can always borrow it, or you can get a gift from your dad, your mom, if they are willing to give it to you, or family or friends to raise that 3%. Mm-hmm. And the lender would finance up to 97% of this loan. This is a game changer. It drops the amount that's necessary to bring the close, mm-hmm. As far as a down payment, and it doesn't require you to have funds in your account. You can get it as a gift from from relatives or friends that are willing to assist you in this process.
Now, do you said with this product though that the seller is allowed to have some of the seller concessions go towards the down payment? Is this the product that you were telling me about?
I'm sure, yes. If there's a certain sales price you have to meet, mm-hmm. and the seller is willing to give a concession to it, I strongly believe that this can go towards the down payment, and you can use that to get into this property.
So it's possible that they could actually use seller concessions for the down payment, or they can get like a family or a friend to give gifts.
Yeah, exactly.
Towards it if they needed it. Okay. Well, that sounds wonderful. Are there any other, besides the 680 credit score, are there any other requirements that you could think of that?
680 credit score, DTI. Remember we talked about that.
Okay, DTI, a max of 50%.
You don't want to carry on too much debt. Exactly.
Okay.
Basically full doc. What that means is you have to have income coming in, right? You for at least 2 years. In the same industry,
okay.
Or and it basically you plan on keeping your job for 3 years afterwards. That's the technical role, okay. Right? So they want to be able to source your income. So that means that they're going to be looking at, paycheck stubs. They're going to be looking at W-2s from the last 2 years. They're okay. going to be looking at they're going to be looking at your bank statements. What kind of stuff comes in, what kind of stuff goes out. Banks, they hate large amounts coming into your bank account that's unsourced.
Right.
So, if you have a big amount coming into your bank account, $5,000, $6,000, $8,000, $9,000, that, you can't really explain where it came from. Banks hate to see that. And then that's going to really push your issue back. So you want to avoid that. If you don't have the down payment side of it down, like the 3%, and you're going conventionally, mm-hmm. you kind of have to look at a different way of approaching the situation, a more creative way. But at the end of the day, it's a great product for first-time homeowners. It is for first-time homeowners. So you can't own a home for the last 3 years.
Right. Yeah, because every year, even if you purchased a house, let's say you purchased a house 3 years ago, right? Technically, if you haven't purchased anything since then, you're considered a first-time home buyer, aren't you?
If that house is on your credit report, you're a homeowner, right? So right. They're looking at the credit history. If you have a mortgage on it, it's a no-go. It's for first-time homeowners.
Okay.
Right? So,
because I've heard somebody say that before. Hey, every 3 years you're a new home buyer.
I mean, if there's nothing on your credit history like that alludes to real estate,
Yeah.
you're considered a first-time homeowner. But that's why they pull your credit, and
Okay.
your mortgage is always going to show up on your credit. So,
That's true.
I mean,
That's very
yeah.
true.
So, like, if you've moved to a different state and you rented for 3 years, you're considered a first-time homeowner,
Okay.
right? So,
Yeah.
and there's no real estate stuff on your credit history.
Right. Got it.
You can take advantage of it. Yes.
Got it. Another thing I was just thinking about with FHA, and I wanted to ask you, as far as appraisals go, you think appraisers are more lenient when it comes to conventional, as far as really giving a good value, as opposed to like a FHA appraiser that's going to try to be as safe and restrictive as possible and not go too high on those numbers? Do you think there's any difference there with the appraisals?
I mean, at the end of the day, the appraisal is out of my hands or out of the loan officer's hands.
Right.
The banks have done a great job, kind of separating the two and making it the appraiser like indebted to the loan officer or the consultant that's working the file because I gave you this amount of business or this or that. It's separate. Usually,
Okay.
The lender is the one ordering the appraisal.
Okay.
There are little tricks that, I have found that have worked. I have no proof that it does work, but little things that I do here and there that I feel might help me with the value. But at the end of the day, there's nothing that part of the business or that side of it is out of my hands. The appraisal, if it comes back, whatever the value we see there is usually what it's going to stay at. I can contest it. I can, send the appraiser, several other comparables, maybe in the neighborhood, as to why I feel like the appraisal might be short. But at the end of the day, it's on the appraiser, and he determines what value is. And he's doing the job.
So that'd probably be a good question for an appraiser. I'll have to talk to one of my appraiser buddies and see, because I mean, on the real estate side, or the realtor side, I should say, it does seem to. It seems like FHA is a little bit more strict when it comes to the appraisals, to me.
Yeah.
And it is actually, when you think about it, because that house has to have a certain level of repairs, right?
Yeah, it has to be a certain standard.
It has to be a certain standard. So that's what it is. It has to be a certain level of repairs on that house. Otherwise, you're not going to get approved for that loan. Whereas conventional, they're not as strict on repairs, right?
Yeah, they're not as strict, but if you're going to get an appraisal done, you still want to have your house look. Think about it for a second. Using an analogy, if you see two people, one dressed terribly, one dressed to the, in a 3-piece suit, looking immaculate,
look sharp.
Yeah,
that's you're gonna sharp.
Sharp. You're gonna think more of the person that's
right.
Sharp.
That's right. That's why I am a stager. That's why I stress to my seller clients.
Yeah.
You better make sure you put that house on the market and present it well the first time you put it out there. Don't shortchange yourself and just throw it all out there any old way. Because I mean, you should see some of the pictures I see online. I cringe. Like I have seen, I'm seeing pictures with stuff all over the counters on the kitchen in the pictures, clothes in the corner. I'm like, no.
I mean, and when the appraiser comes around, when the appraiser comes around and they see that, psychologically, it's going to make an impact, like
not only that, when a buyer comes around, they're going to lowball you because they're going to be like, this house has so many things going on here. I need to get it for less. I need to get it for less money.
Of course, exactly.
Exactly.
So,
I agree. It has to be presented right.
Yeah, so mortgage game, if you're going to do a refinance or you're going to buy, the appraisal is important. You want
Yes.
to keep it pristine. You want to keep it nice. You want to keep it presentable. Go see DI Staging, and they'll get you up to.
I'll get you right. I'll get you straight. All right, Josh.
Yeah.
Well, you know what? I really appreciate you being on today and taking your time to explain that product.
Thank you.
And I'm pretty sure I'll be telling a lot of my clients about it and sending them your way. If there's people watching that's interested and want to get in touch with you, give them your information.
Yeah, absolutely. Website address is www.vibrantmortgagegroup, spelled out, .com. Telephone number 855-499-3864. We're brokers. We work with several different lenders. We get competitive quotes for our clients. That's why people love us. And we're here for you guys. Your home, your terms.
Awesome. And I will say, Josh does do a great job with taking his time with you and giving quality service. I appreciate. That's okay. That's okay. That just means we're busy. We're busy. We're good at what we do, so we're busy.
Yeah.
Anyway, thank you so much, guys. I hope today's topic made some sense to you. I hope it made some sense. FHA 3.5% or conventional 3%.
3%.
Check out that product. See if it works for you. All right, we're going to see you again next Sunday on Sensible Sundays. Look forward to it. And you guys, be sure to be inspired and act on your inspiration. Bye.
Next time.